We spend a lot of time on analysing different things. We'll be looking at what's growing, what's inflation going to do, how the central banks are going to react to that, what are they going to do with interest rates. After all that analysis, trying to find out what we should be buying for our clients, how we're going to package all that research and knowledge into the best combination of assets for our clients to grow that wealth over time.
Have you ever heard of the term fund manager before? Maybe you have, maybe you haven't. Well, that's what we are unpacking today. Welcome to Breaking Down Markets, a podcast series where we make financial markets simple, relevant, informative, and most importantly, educative. My name is Sithole, and previously we took a deep dive into what the JSE is, what investing is, and what brokers really do. Joining me to unpack who fund managers are, what they do, and why they matter in the financial industry is Warren Buhai, Senior Portfolio Manager at Stanlib Asset Management. Well, thank you so much for joining us today. We truly appreciate it.
Thanks for inviting me.
Awesome. But firstly, we heard a lot about fund managers, but actually, in simple terms, what do they actually do?
So at the end of the day, what we're responsible for is managing people's savings in the long run to generate wealth for them. They give us their savings in different kinds of products, be it a unit trust, a pension fund. We take that money, invest in various things, and try and grow that wealth over time.
Okay. Someone like me, when I'm thinking about a fund manager, I'm thinking of someone who sits all day and picks stocks. And today I'm taking Tiger Brands, I'm taking Sithole, Boxer, We Buy Cars, and so forth. Am I accurate?
So that's a big part of it.
Okay.
But to give you a sense of what my daily day entails is we spend a lot of time on analysing different things. And I'd bucket it probably in two broader buckets at a high level. The economy, we'll be looking at what's growing, what's inflation going to do, how the central banks are going to react to that, what are they going to do with interest rates. As you know, if they cut interest rates, it helps people. If they increase them, it pulls back on spending, things like that. What happens with the flow of money? What are they doing with money supply? So broadly speaking on the economy. Then to your point, we do look a lot at company analysis. And remember, we're trying to buy both company shares and potentially their bonds as well. So we've got to analyze those companies, who's doing well, who's doing badly, how are they being impacted by all those economic developments. So various things like that. We look at things like currencies, like commodities. So analyzing a lot of stuff during the day. And at the end of the day, after all that analysis, trying to find out what we should be buying for our clients, how we're going to package all that research and knowledge into the best combination of assets for our clients to grow that wealth over time.
Okay. Are your clients individual clients or companies?
It's a mixture.
Okay.
Partly in unit trusts, you generally have investors from the retail, what we call the retail public. Okay. So that's individuals in the public putting their savings into the unit trust. They can put it in as low as 100 Rand a month on a debit order into a unit trust. And then on the corporate side, what we call the institutional market, that's institutions that have massive pension funds and give us part of those pension funds to manage, again, ultimately for their employees over time to grow their pension money over various decades.
Okay, so let's break it down a little bit more.
Yep.
I am your client now. I'm the individual coming to you. So coming to your office, then what is the process like in terms of wanting to get your.
So you generally either come into our office or speak to a financial advisor. And at the end of the day, what the financial advisor is trying to find out from you is what is your risk tolerance. And what I mean by that is what kind of portfolio or fund you want to go into that my team and myself are ultimately going to manage to grow your wealth, but importantly, connect you with the right fund. And what I mean by that in the funds that we manage, what we call multi-asset funds, it's as it sounds. It's multiple assets in those funds. So things like equities, like bonds, like commodities, like currencies, all go into this funds, like property stocks. And we're trying to blend those different assets into the best combination that we think will grow your wealth over time. But importantly, when you come in, what I mean by risk tolerance is, are you going to go into a fund, what we call a low equity fund, that's capped at 40% total equities, or a medium equity fund that's generally between 40 and 60% equities, or a high equity multi-asset fund, which is capped at 75% equities. Now you can imagine the difference in those funds over time is in their volatility and what the returns look like. So if you put your money into a lower equity fund, it's going to be much smoother over time. The return might not be as high as when you put it into a fund with a lot more equity, but it's going to be much smoother. Generally, those clients tend to be the older clients in retirement that can't take a lot of risk. What we find is the clients that are suited for the higher equity funds are the ones that are much younger and have a much longer period to compound returns. They're happy to take bigger risk in funds, and the reason why they're happier to take bigger risk is because they have time to recover over longer periods. So if the market corrects in the next 5 or 10 years, they've got much longer to recover for that. If you're in retirement, you don't have the time horizon to recover from market downturns, and therefore you shouldn't be investing in a fund with a lot of equity exposure.
Okay.
So there's different types of funds that are appropriate for different clients that come into our business or that go to financial advisors, and it's really, we find over time that's one of the most important things with clients is making sure they're married to the right fund they invested in. So when they see the returns of those funds, whether they look at it monthly, quarterly or annually, they're not surprised about what's coming out. Okay. This matching between expectations and what we're doing is critical to us in how we manage the funds.
Okay. I want us to be more practical, so I'm going to give you 2 scenarios. One individual is 20 years and the other individual is 40 years. So what process would you take with the individual who's 20 years and what kind of services would you provide for that 20-year-old and the services you'd provide for the 40-year-old?
Yeah.
Yeah.
It's a good question to make it, as you say, very practical.
Yeah.
I like that you use 40 as the older version. For me,
what did I say? 50?
I'm turning 50 in a couple of months in February.
Let's use 50.
Let's use 50 with hopefully 10 years to retirement. So the 20-year-old clearly is only going to retire in, let's use 60 as a round figure. Retirement ages are moving up over time because people are living longer. But if that 20-year-old comes into us and is looking to save money in the long run, let's just say for their retirement.
Yes.
So they've got 40 years to invest.
Okay.
Clearly over a 40-year period, you're able to take a lot of equity risk. And generally we see equities as the highest risk asset class because they're the most volatile. But with that volatility also comes the prospect of a much better return over long periods of time.
Okay.
So equity is the highest risk asset class, but as I say, related to that is the highest return. The lowest risk asset class is generally seen as cash. Cash is very stable. You earn lower returns than equity over long periods of time, but you don't have that volatility. Okay. And we find that when people invest, the scariest thing for them is seeing volatility. So the problem actually with modern day technology, one of the problems is clients can see their portfolios every day online.
Yeah.
And that's dangerous because if they look at it and there's been a tough week in markets and their portfolio is down 3%, they're panicking. They're not thinking about the 40-year time horizon. You know, we saw 2 big drawdowns in markets, both in 2000 after the dot-com bubble burst and in the global financial crisis, where markets in many places in the world more than halved. Now, you can imagine if you're in a portfolio of pure equities and your wealth that you've built up halves in time, you want to panic.
Yeah.
And that's not what you want from clients. You want them to have that long-term time horizon because if they stayed in the market, even though it halved, within 5, 10, 15 years, they've made a lot more money.
Okay.
And that's the kind of thought process.
Yeah.
To go to the older person at 50 who's only got 10 years to retirement, clearly they don't have the ability to take nearly as much risk as the 20-year-old. Because if they're 50, and let's say in 5 years' time when they're 55, the market were to have a massive correction again and halve, you can imagine all that wealth they've built up from 20 to 55 now could halve. And they've got to hope in those last 5 years to retirement, 55 to 60, it now recovers all those losses.
Yeah.
And that's going to be a difficult thing, to achieve. It might happen, but the risk is clearly very different at 55. If you want to retire at 60, you don't want to lose half your savings at 55 sticking in equities. So again, we would say the 20-year-old has the ability to go into funds that have much more equity in them because it's the high-risk asset classes. It therefore has the highest risk of huge drawdowns. But likewise, over multi-decade periods, like 40 years, without a doubt, it has the prospect of generating much higher returns and therefore generating much more wealth for them if they're starting to invest at 20. The client coming to us at 50 doesn't have that 40-year time horizon anymore. They're trying to protect, hopefully they've saved a lot over the previous 35, 40 years, and they can, just look at more stable returns, lower equity returns, much more stable, and don't have the risk of those huge drawdowns coming over the last 5 to 10 years before they retire.
Awesome. So in terms of like the services that they get, you are investing into stocks. What else for them?
So we'll
It's a
invest.
conversation that you have with the client that I want this, or you are the one who's saying, I suggest that you have this.
Yeah, I don't deal directly with clients off the street.
Okay.
We have most of the people come into our unit trust through financial advisors.
Okay.
So a client in the street will go to a financial advisor, be that from a bank, an insurance company, or what we call independent financial advisors, and they'll advise them which funds to go into. They'll do a risk assessment, as I say, and see, trying to marry their risk tolerance to what funds they should go into.
Okay.
Now, when we manage the client's money, we'll go into the major asset classes will be equities, which I know you've discussed on a previous episode of this series, which is great. Bonds. Now, bonds is where you lend money essentially to governments or companies and get interest paid back to you for that. So you're lending them money like a bank would. But interestingly, both governments and companies go to people like us who've got a lot of savings to manage, and they ask us for money. We're happy to give it to them as long as they give us a decent return.
Okay.
And that return will depend on how risky the government or company is that's giving it to us. So that's equities, bonds. Things like commodities are important. In South Africa, especially, commodities are very important, especially the precious metal commodities. So we can invest in the likes of gold, platinum, palladium, which are mined in South Africa. And commodities have a very different risk profile to either equities or bonds. Then there's things like property stocks, which property stocks own many buildings, be it retail stores, shopping centers, office buildings. They're quite a different risk profile to other equities and bonds. And then things like cash, as I say, is the lowest risk asset class. So we use all these different types of asset classes. And what we're essentially trying to do is put them together to get the best outcome for our clients. And the reason why we use different asset classes is they all have different return profiles, so they all work differently.
Okay.
Take the good example, an easy example, when growth starts slowing in a country, and if it was going into recession, equities would start doing badly. Why would equities do badly? Because you expect companies' earnings to go down, and they go down. Whereas bonds, interestingly, people then take their money out of equities and put them into bonds because they want the security of that interest being paid back to them. And bonds tend to do very well as economies slow down.
Okay.
So that's what you're trying to marry. If our equities do badly, do our bonds do better? Maybe do the commodities do better? Maybe property stocks do better when equities are going down. So you're trying to mix different return profiles, what we call diversification. And that diversification marries all these different asset classes into a portfolio to give a much smoother ride for our clients over time, instead of just sitting in any one asset class, which is a much more volatile ride for them.
Sure. Wow. Okay. You really unpacked a lot. But now when you invest money into this different kinds of portfolios, what is it that you look at most of the time?
So we try to, at the end of the day, understand, is that asset class we're buying into, is it cheap? And do we think there's good return in it going forward?
Okay.
So within equities, to the point you raised earlier of individual companies' names, we're going into deep detail on that company and the industry it operates in. So Tiger Brands, you mentioned, is a food producer. Into Tiger Brands, what do we think is going to happen? Looking at the South African economy, looking at the other African countries it's involved in, what are they able to do with their pricing? So we're looking at their results coming out every 6 months. We're meeting with management. What's their strategy? If we buy into what management is doing with the strategy and we can see there's upside, the economy is growing, the African economy is growing, they see lots of avenues to grow into, and importantly, it's cheap enough for us, the stock itself is cheap enough, we'll buy that stock and put it in the portfolio because we think it's going to generate wealth for our clients over time. Bonds are slightly different. And again, you're looking at which governments would you lend money to. South Africa is obviously the one closest to us, but we can invest in US government bonds, British government bonds, Australian government bonds. They've all got very different drivers of their economies and therefore how their bonds will behave. So at the end of the day, we're doing a lot of research of what drives the price of those different asset classes and then making a judgment call based on all that research we do, all the debates we have as a team in deciding where best to put our clients' money to try and get that smooth growth over time and compound returns over very long periods of time.
Okay. You spoke about markets being very volatile. So how do you balance, the risk and the return for your clients?
Yeah, that's exactly one of our biggest jobs is exactly that, is that there's a lot of noise in markets. The best example I like to use is geopolitics because it's so much in the news these days with what's happening with the Ukraine war, what was happening recently in the Middle East. And geopolitics tends to impact markets from a noise perspective. So when there's big news out there, like the day that Russia invaded Ukraine, markets moved quickly.
Yeah.
They moved quickly to try and price in, what does this mean? And for us, you've got to have a clear thought. You've got to be unemotional. The biggest issue that we find when investors invest their own money and don't give it to professional money managers is that they act on emotion. So I wake up, I open my phone, and I look at the news, and the news says Russia's invaded Ukraine. Now already, if I'm an individual investor and I've invested money, I'm thinking, what does this mean? Is World War III starting? Are my equities going to halve? Panic, and then you make the wrong decisions. As opposed to taking a step back, which we're trying to do, and say, we're trying to manage our clients' money over multiple decades. Is this news event going to have any impact on that longer term story? And if it is, how big the impact's going to be? A lot of that comes through judgment. A lot of it comes through analysis of historical performance, of what happened in previous historical periods of war. And what you find as this example, when you look at previous geopolitical events, they tend to not have a big impact on markets when you go longer time horizon than 6 months.
Okay.
So they can have an impact on the short-term market movement, becomes much more volatile because exactly this, the people trading in the market like us are trying to figure out what impact it's going to have. So we might buy and sell different things, and that has an impact in the short term. But in the medium to longer term, beyond 6 months, the geopolitics doesn't tend to have a big impact on markets. So we can take that view because we're managing people's money over multiple decades, is we can have a much more non-emotional, quantitative base. We can look at previous scenarios, look what happened to markets during those, and try and say, okay, events happen today, but it's not unique to history. It's happened many times in history. And during those similar historical events, what actually happened to equities, what happened to bonds, what happened to commodities. And based on all that research we do, we can bring it back to our portfolios. Okay, we've got these various investments. Does anything change based on this news to what we've got invested in our portfolios? And do we need to, as my boss loves to say, move our feet and change the portfolio?
Yeah.
Often we do, based on all that research we've done. But importantly for us, it's got to be based on research that you've done. You've seen historical events. You can't just guess on what's going to happen. You have to base it on hard, detailed research that we've done, and why we have a lot of people in our team with different experience, different knowledge about different things that can come to the party depending on what's happened, what the news is, what we're researching. We need those different inputs. There's no point in all of us having the same experience or looking at the same thing. We need people looking at different things, coming with different backgrounds, different educational backgrounds, different kind of work backgrounds, and therefore different perspectives. Very important for us to blend the different perspectives and views in coming out with the best solution for our client.
I'm very curious to know, you've mentioned, let's say, clients panicking, right? So if I am your client and I'm panicking because I'm seeing that, okay, I'm going to use that scenario with Russia and Ukraine, right? And markets are acting on it. Do I come to you and be like, okay, I feel like you need to take out my money out of this and put it in this, or you are the one who makes that decision? Yes. Can I influence you to make that decision, or you are the one who advises me to say, no, let's rather do this and that?
So we do have those panic calls from clients and big clients that have got multiple billions invested in our funds. And when something like that happens, we often do get the call from a client. And we'll meet with the client on the same day and explain to them exactly that. Here's what we see in history. Many times there's been war breaking out in many different parts of the world, and we show them historically what happens. There's panic in the market for the first few months. Often it's actually a couple of days or no longer than that.
Yeah.
But look at what happens 6 months later, 12 months later, 24 months later. Generally, markets are higher than when they were before this invasion.
Okay.
And that's the only way to calm clients' nerves, to show them that you can do the detailed research, understand what's happened historically, and then relate it to what's happening today. So they're not flying blind, I guess is the best analogy. The only way you're going to calm their nerves is to show them you're doing the analysis, you're taking an unemotional approach to it, importantly. You're not panicking for the sake of panic. There might be a reason to panic, let's say if aliens invade or something really that you've never seen before in the world. But certainly most of the things you see today have happened at some time in history.
Yeah.
Even the AI, which is the obvious one today,
Yeah.
and we've had this conversation recently with our clients, they say, is AI a bubble? It's a great topic at the moment. Again, we can go back in history and show them different periods where there was huge technological change, how much money was spent, like the AI being spent today, what were companies valued at, and give them a quantitative-based view or a numbers-based view on the research we've done historically, answering that question, is AI a bubble? And again, that calms their nerves and, okay, these guys are on top of it. They're doing a lot of research. They're looking at history, what happened, what could happen now going forward, but importantly, based on what's happened historically. We're not just, again, guessing on what could happen. And we think this is why it's important for people to use professional money managers, because they've got the resources, importantly, to do a lot of this research. They're not just, as I say, guessing, or it's not just me on my own trying to cover all of this. We've got a very big team, thankfully, very different experience around our team, different ages in our team, different profiles, etc. And that's what we think is the big benefit of using professional money managers as opposed to someone trying to do this on their own. There are successful people who do it on their own, but if I use the betting analogy, people can bet a lot and they can be lucky and make a lot of money, but the average bettor over time will lose a lot of money. We don't want the average person on the street who's trying to grow their wealth with savings to all do this on their own, because the risk of getting it wrong is quite high. And it's obviously your savings you're playing with. You don't want to lose half your savings over time, clearly.
So is AI in a bubble?
We don't think it is.
Okay.
As a view of our team, purely because we're at the very early stages of the rollout. While some of the shares in the AI sphere are expensive, again, comparing to previous historical cycles like this, they're not as expensive as they were in previous cycles. So that's probably the major reason that we don't think it's as big a bubble as it was, say, in the late 90s with the internet rollout.
Okay, all right. We normally hear about analysts in investing, but analysts and fund managers, how do they correlate? Do they work together? What is the difference between the two?
Yeah, so there's a hybrid answer, as there often is in finance. I started as an analyst in 2005 in the industry as a mining analyst. So I just looked at mining companies. I went to visit the mines. I went to the DRC and down in a copper mine, and Angola on the diamond mines. It was a wonderful job. I got to go see all these mines and how they function. I was a pure analyst, just looked at and I tried to value those companies. What were they doing in these various countries in the mines? And I came up with a valuation, and let's say the valuation was 100 and the share price was trading at 50. Obviously, we thought there was a lot of upside. If it was only at 50 and I thought the value was 100, and we could invest in that company and make a lot of money for our clients. What a fund manager does is take all this work that the analysts do, takes it into account, and then has got to make the decisions. So fund managers are much more decision makers, where the analyst is doing a lot more of the detailed work that feeds into our decision making. Okay. And that's, I'd say, is the distinction.
So fund managers have the final say when...
Have the final say in where to put our client savings, exactly. Where the analyst is mostly going to be focused on analysis, building models, what a company's worth, what's happening with economies, much more the analytical research side, as opposed to making the money, where we're putting the money decision.
We spoke previously about the AI bubble, but now I want us to talk about AI in the world of finance. And how are you using AI? And is it still your job? Is it still relevant? Do we still need you as a fund manager in terms of investing? Can't I just now do my own thing?
Great question. And what worries me is the tools are going to get so good that my job becomes redundant. We think at the moment the best is the combination of the two, for the simple reason that the way we're using AI, and we are using it more and more as time goes on, is it's brilliant at summarizing information. So stuff that used to take me days, weeks, and months to read through, because I used to print documents this high of companies' results and presentations, and I used to manually go through them, make notes, then I had to summarize my notes, and I had to feed back to the portfolio managers. Now AI can take those results, it can take results of thousands of companies at once and summarize them for us. Of course, you've got to check for hallucinations and things like that, but AI can do a lot of that, what we call grunt work. A lot that many analysts used to take a long time to do, can do very quickly now. But importantly, we think you've got to have that human oversight. What does that all mean? So summaries are great and they can try and give you some insight, but it doesn't have the same personal experience that we've had in markets of seeing different cycles, seeing what that information means to companies, and importantly, looking how the market's behaving and does that impact our decision making. We think it struggles a lot with that.
Okay. Well, Warren, thank you so much for unpacking this for us. We truly appreciate it. And that's where we're going to leave it on for this episode, Breaking Down Markets. If you have another financial complex topic that you want us to break down, definitely comment down the comment section, like, follow, so that you don't miss any future episode. Until I see you next time, goodbye.